do that job of devaluing the dollar while maintaining its position as a global reserve currency?
I think it would be good for another cycle. I think that some of the things could backfire later. Like the Fed is going to have to respond to potentially to tariff policy and what that does for prices, and that could keep them a little higher for longer.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.
But it's certainly starting out a really big factor, given that we're already in a fiscally dominant environment. And I think what further amplifies it is that some of the trends that they're at least trying to tackle are structural. And so I've highlighted before that, for example, the trade deficits are structural. These have built up for decades, and they have very entrenched reasons to exist. And they are causing a lot of issues. This is something I've been, writing about for probably 5 years now, is the structural trade deficit situation. And so the fact that they're trying to tackle them is kind of a historic moment. And the same thing with fiscal deficits. So we can probably get into some of that, but I would say that, the early period here, I wouldn't necessarily extrapolate for 4 years, other than obviously Trump's a showman. The first term had a lot going on, and we probably should expect similar. Biggest attempt we've seen by the administration to even care or focus on the trade deficit. For a little bit of background, the way that the trade deficit works in the U.S. is different than most other countries. So most countries, their currency trades mainly on fundamentals of things like interest rate differentials or the trade balance. If some currency gets quite weak, it makes making things very competitive there, and it hurts their ability to import. And so in addition to interest rate changes, they generally work itself out. They kind of hits an equilibrium, and then manufacturing comes back to it, and they slow down their imports, and then they kind of right size it out. The US is interesting because, unlike most other currencies, we have an extra monetary premium on top of ours. There are countries all around the world that hold dollar-denominated assets just to store value in, which means that we have this kind of persistent extra demand. It's kind of like how if gold was priced only on its utility aspects, it'd be way cheaper than the fact that tons of people just hold gold as the best analog money. And it's kind of like that for the dollar. I think that it's interesting because they maintain the world reserve currency in the GOP platform. And him and his Treasury Secretary and his group around him has explicitly said, we want to keep the dollar as a global reserve currency, despite the fact that we want to address the trade balance. Without a lot of talk about that's what's fueling, those are kind of two halves of the same thing. Now, the person in his orbit that probably gets that the most from my reading is Stephen Miran, I believe is his last name. He's been nominated to be his head economic advisor. And he's the one that's done a lot of work on this, saying that some of these policies might be dollar strong initially, but then later dollar weak. Technically, there is a difference between how cyclically strong the dollar is and whether or not it's the global reserve currency. So Trump has talked before about other currencies being unfairly cheap, talking about potentially exchange rate differentials as part of a negotiation, like intentional dollar weakening. And you can have a burst of... Right, so it's been fairly strong. It's been in a strong cycle for about 10 years. Really, in the 50 plus years of being this kind of floating exchange rate, post Bretton Woods environment, there's really been only 3 major dollar cycles. So they did really strong into the 80s, and they did the Plaza Accord. Then they got really strong into the late 90s, and then that had a big weakening. And then we've really been strong ever since 2014 or so. So we're about a decade into a fairly strong band of the dollar. Now there's weakening years like 2017. There's really strong dollar years like 2022. But a lot of that is in the context of being on the kind of the higher side of that strong dollar cycle. And I think there's a couple different factors for that. One is these ebbs and flows generally happen because of quantitative easing, interest rate differentials, the strength of the economy. And I think what we're seeing in recent years is a lot of own goals in those other currency environments. So Canada, for example, not want
to do that job of devaluing the dollar while maintaining its position as a global reserve currency.
I think it would be good for another cycle. I think that kind of buys some time. And Plaza Accord based after the hotel it was in. So this one would probably be something like the Mar-a-Lago Accord. So he has talked about currency differentials more than say Biden did. It's clear it's on something on Trump's mind. And if we do see ongoing negotiations around these tariffs and things like that, we could see currency components in there. The initial Plaza Accord was done for similar reasons, which is when in the earlier phase of this hollowing out started to happen, where Japan was basically eating our lunch, Taiwan was eating our lunch. Like the foreign cars are coming in, and like we're having a very strong dollar environment because the Volcker had done really tight monetary policy trying to curtail inflation. All these factors made the dollar strong, made it hard to manufacture things. So they intentionally did this to kind of, and sometimes the entities that own a lot of those assets also have a lot of the debt. Sometimes they're different groups, and sometimes they're overlapping groups. And generally speaking, when you get a strong dollar environment, the whole world kind of gets slowed down a little bit. They're in more currency defense mode. They're not accumulating reserves as rapidly. If anything, they could be selling treasuries to support their own currencies, and that can ricochet back into U.S. markets and give us all sorts of turbulence. Like in 2020, like in 2022, these things can happen. And so by weakening the dollar, they ease the debt burdens of a lot of emerging markets in particular. That gives them a little bit of a boom, which is generally comes back and helps U.S. asset prices and U.S. economic growth as well, keeps them happy, and then kind of keeps the whole cycle going. And of course, one of the big costs of that is it can keep inflation sticky, because if you weaken the dollar, you can get higher energy prices, marginally higher import prices, and kind of have that trade-off.
Interesting. Okay, it seems to.
And that kind of reminds the other side, like if you don't continue working with us, we can go back to playing bad cop again. And especially because if you don't know how serious the other person is, if you're playing chicken with someone and they just kind of like throw out their steering wheel from their car, like you're like, well, this person might not, like they may be willing to deal with kind of consequences to a high degree. So like I have to really think twice if I want to play chicken with this. So it probably the strong way to describe it would be it's a good opening position. The bearish way to describe it would be to say that it hurts long-standing allied relationships, and it kind of has this everyone for themselves approach, which means that now all these other countries, if anything, might band together kind of against us and say, well, we're all the bullied victims here. Let's support each other, and let's make sure that as we deal with the U.S., we're somewhat coordinated, because alone we're vulnerable. But they purposely issued a lot of extra T-bills to fund a lot of their deficit, which was, they did that for kind of pro-liquidity reasons. And Besant was critical of that practice. And yet he has said that in the kind of the first half of the year going forward, he's actually going to keep those policies in place, which he himself had been critical of. And one of the kind of implications of that policy is generally lower 10-year and 30-year yields, because you're issuing less of those really long duration ones that you might otherwise be issuing more of, and instead issuing more T-bills. So I do think that they're already erring dovish to some extent, but that's also somewhat doing damage control on, if you get a dollar spike because of aggressive tariff announcements, but then you also get the 10-year a little bit lower because you're not going to flood the market with duration. It's kind of a balancing fact. But yeah, so far, I would say that they generally are taking at least initial steps to try to get yields down. But some of the things could backfire later. Like the Fed is going to have to respond potentially to tariff policy and what that does for prices. And that could keep them a little higher for longer, down to the Fed's official target. And so that's kind of one factor that they have. In addition, we've seen an unusually hawkish long end, despite the cutting that they have done. So when the Fed did try to, moderately ease policy by trimming rates here and there, the long end went up. And so the part of the curve that people actually borrow in, mortgages, business loans, that kind of thing, that's not really been eased.
Right.
So there's still pressure on commercial real estate. There's still pressure on maybe not residential real estate prices as much, but certainly on volumes that are in turnover that are happening. A lot of that is pressured. Right. And so that's kind of still in a holding pattern. And then probably the couple big variables to watch is, one, as long as the debt ceiling is being negotiated, that is ironically somewhat pro-liquidity, because it could mean that the Treasury has to dump their cash into the market to keep paying their bills. But if we look past that, look toward more of the center, the middle of the year, the reverse repo facility, their balance sheet look exactly like they wanted to for their quarterly report. And so there's generally more demand to move money around literally in that day or two period. And so we've now had 2 quarters where there have been pretty clear signs of liquidity strain. So 2 quarters ago, someone had to use the Fed's repo facility. It was only $2 billion, but it was a new signal. And then in the most recent quarter, they didn't have to use the Fed's repo facility, but there was a pretty clear funding strain that happened. So everybody was able to get the liquidity they needed, but it was expensive. So every quarter, specifically at the end of the quarter, we get a little bit of a snapshot of either looking at the price of liquidity or needing to use the Fed's liquidity facilities to say, okay, what's the state of all these musical chair, the music's kind of briefly ending for a second. We get a little glimpse of liquidity constraints. That gives us some indication. And in addition, we're at kind of the rough targets. So they've talked about the balance sheet as a percentage of GDP being in like the 10 to 11% band. We're kind of already in the top end of that band now. And so whether or not looking at their kind of quantitative measure, we have more twists and turns ahead, but probably still reasonable for liquidity.
Interesting. And one thing that's happening on the macro front, maybe the geopolitical front, this has been a slow trend shift in this direction for a long time now. But maybe just to name some of the acute events, it was when Russia invaded Ukraine and then the United States seized the assets of Russia. And then all the central banks started to reevaluate their position on the United States as the reserve currency. I think the narrative at least was good for Bitcoin. Since then, Michael Saylor has been really memeing Bitcoin with MicroStrategy, now called Strategy, into being a corporate balance sheet asset, which I think extends upwards into central banks as well. And then more recently, the Czech National Bank is considering incorporating Bitcoin into its foreign exchange reserves. Nothing has been really decided upon, but there's a proposal to reallocate 5% of the Czech National Bank into Bitcoin, which is just crazy to think about in the long arc of crypto as I've been in it. When I came into crypto in 2017 and Bitcoiners were talking to me about how Bitcoin would eventually show up on central banks' balance sheets. And that seemed ludicrous at the time. And here we are 8 years later, and there's truly a proposal like this. What can you tell us about your interpretation of the macro geopolitical